Now, I'm not sure if this is true, but Albert Einstein once said that compounding was the eighth wonder of the world. Well, for the purposes of this video, it doesn't really matter whether he said it or not. I can tell you it is a fantastic tool and it is often overlooked by most investors and traders. And there's a simple way within your trading that you can utilize a simple compounding trick that can really grow your returns a lot faster. Now, normal compounding is about earning interest on interest. We want to be earning profit on profit in trading, and I've been using this method for many years very successfully, and I'm going to show you with a few examples how it all works and why you should be using it in your trading right now. So with that, let's get into it. So let me show you how this works through the eyes of an example. So you risk a fixed £100 per trade on your £10,000 trading fund. Now let's assume, and remember this is a very much hypothetical example to prove a point, you trade 10 times per month, winning 6 of those and losing 4. So that's a 60% win ratio at a 2-to-1 risk return. What does that mean? For every £200 you'd make, you would potentially be risking 100. That equals a very good monthly return of £800, or otherwise put 8% per month. So now let's assume that you can do that consistently every month for the next 24 months. So how much money would you make doing that? Well, the answer over those 24 months is £19,200. Nothing to be sniffed at and very good in itself. But what if you could have compounded those returns? How much would you have made and how could you actually do that? So we're going to do something slightly different. In the first month, we are risking 1% of our £10,000 trading pot, i.e. 100 risked per trade in that first month of the 24. So you'd still return the same 800 as the fixed method that we saw previously. But what if you still used that compounding moving forward for the rest of those 24 months? What would be the difference? So for month 2, your pot has now grown to 10,800. So you're going to risk 1% of that 10,800, not the fixed £100. So you're now actually risking £108 per trade. And so by the end of month 2, you've made 864. That's £64 more than the other method. And your pot now has grown to £11,664. You do exactly the same in month 3 and you've made £933.12 by the end of that month. So you continue to do that until the end of month 24. How much did you make compounding those returns with our new method? Remember, you made £19,200 on the fixed approach, which is all very good, but with our new method, you've made a staggering £53,411.81. A big difference to our fixed approach. Now, using the compounding method, you've actually taken on no more risk over that 24-month period. You're always using the fixed 1% per risk per trade against the value of the portfolio, but you've made a far bigger return. So let's picturise that by looking at the example on a spreadsheet. So I've just thrown together a real simple spreadsheet here. Now you can see up in the inputs, I've put our initial capital of £10,000, and remember we were making 8% per month. Now, in terms of the fixed return, 1 year 96%, all very good. 2 years 192%, but the big difference, it's not so apparent on year 1, 152 versus 96, but after 2 years it is huge, up to 585% return versus 192%. Now remember, this is a very simplistic example. It's here to prove a point that compounding is far more powerful, more useful, if you're getting these sort of returns. And I've put that into graphical format, and you can see actually after 3 years it's 159,000, then 400,000 after 4 years, and then just over 1 million after 5 years. And I've got to say, trading never works that smoothly, but again, it's to illustrate a point, and watch how it grows exponentially. The first year or so, not so big, and then it just takes off. And a lot of people lose patience in the trading world in that first year or so. But if you put this into your trading plan, get consistent with it, building the rules of the game, you can, as you can see, make seriously quicker, faster returns compounding. It's just a clever way of utilizing a very simple bit of maths. And as I pointed out, you are actually taking on no more risk as your profits, your portfolio, your initial capital grows. So what rules do I use, in compounding, in my trading? How do I deploy it? Now, remember, these are my rules. You can do it, how you see fit, but I review it monthly on the returns, and then I adjust the trade size accordingly. And if I have a losing month, I keep it the same as that previous month. Remember, that's my method. Find out a way that works best for you and get that into your trading plan. So to summarize and to cement the idea, you are compounding your profits by utilizing a fixed percentage of risk. So there you go, one of the secrets of trading investing that not many people do use. Get it into your trading plan, enable it and use it consistently. It is a really simple concept. If you've got an edge, a statistical advantage, then over time compounding is a no-brainer. You're going to make far more than, say, that fixed method that we saw in the example. Now, if you want to learn more how you can utilize this compounding method in your risk and trade management rules, how you build your trading plan, strategies, the markets, how it all works, then I've got a fantastic playlist for you. It's our ultimate free trading course. It's all free on YouTube, and it's work your way from the top to the bottom, and it's going to take you to the next level, and that is coming up right now.